All right, good afternoon and welcome to Market Domination. I'm Myles Udland in for Josh Lipton on this Friday afternoon live from our New York City headquarters. Just under an hour to go until the closing bell here on Wall Street. Stocks looking at a mixed picture. Tech staging a rally after opening sharply in the red this morning, continuing Thursday's move. Let's go over to Jared Blickery, talk a little bit more about what he is seeing in the markets as we head towards the close of this week. Jared.
Thank you, Myles. We started out kind of scarily this morning. Key markets, not the Dow, which is, been underwater all day, but let's take a look at the NASDAQ. Started the day off below its 50-day moving average. That is a key technical level, but it has risen above it right now, and you can see it's looking at gains of about 2/3%. Importantly, for the week, also it is in the green here, and the S&P 500 holding on to gains of 0.5% over these 5 days. And just taking a look at the intraday, you can see there too, it started out the day below that key technical level. It has managed to climb above it. So the bottom line for investors is this is a rally within a bull market where the dip is still getting bought rather aggressively. Rather shallow pullbacks here are seeing strong participation to the upside. Here's a 10-year T-note yield up 3 basis points to 4.14%. The 30-year up 4 basis points to 4.74%. US dollar index also slightly in rally mode there. And I should point out the VIX as well. That rose to 23, actually kind of spiked higher on the open this morning, but it has now settled down to 19 and change below that key 20 level that a lot of people look at. So here's a sector breakdown, and it is a story of energy and tech today. Utility in third place, but energy and tech above 1% for the day. Materials, financials, and communication services, those are the only 3 sectors in the red. And let's take a peek at the NASDAQ 100 because guess what? NVIDIA, another market that started the day below that key technical level and risen above. It's up 2%. Microsoft up 1.5%. Tesla almost 2%. So we've had some scary down days this week, but for the most part, things have recovered. And if we peek inside the semiconductor industry here, we see Micron leading. That's up 5.7%. Broadcom up over 1%. In software, it is, we see actually a little bit more strength. Oracle up 4%, Intuit up 2%, Salesforce up 1.75%, and Workday up almost 4%. So software looking a little bit stronger than the semiconductors. And then finally taking a look at the disruption space, aside from Tesla, let me just put this on an equal weighted value. We see a lot of participation here. We've seen weakness in smaller names recently, but seeing a little bit more risk on today outside of the crypto realm. And let me just leave you on that because Bitcoin down 3%. That is at 95,708. So crypto, some people say it's a leading indicator, not looking that great right now. We'll have to see where that shakes out.
Yeah, we'll talk a little bit more about that, Jared, in about an hour. Of course, crypto markets are 24/7, so we won't get the close there. But I certainly think the story of the last 48 hours in markets has been crypto. We'll check in with that in just a little bit. Also weighing, though, on investors' minds is the future of Fed policy and whether we will actually see a cut at the Fed's final meeting of the year, which is just about a month away. Yahoo Finance's Fed correspondent Jennifer Schonberger is here with more. Jen.
Hey, Myles, a rate cut in December is becoming increasingly doubtful as more Fed officials are expressing caution about cutting rates further. Today, Kansas City Fed President Jeff Schmid, the latest to reiterate that he believes inflation is too high right now and that he thinks that going into the December meeting, there's a chance, he suggested, that he could hold rates steady after dissenting at the last policy meeting where he also preferred to hold rates steady. He doesn't think that cutting rates further could help boost the job market because the stresses that he is seeing there, he believes, are more structural, long-term issues such as technology and changes in immigration policy, though he said, quote, rate cuts could have longer lasting effects on inflation as our commitment to our 2% objective increasingly comes into question. This was my rationale for dissenting, he says, against the rate cut at the last meeting and one that continues to guide my thoughts as I head into the meeting in December. Schmid's comments further accentuating the divide that we're seeing right right now within the Fed, as there is a growing chorus of more officials looking to hold rates steady. Take a look at this chart and you will see how the line is really being redrawn for what the median expectation was for 3 rate cuts this year. Against a December rate cut at this point looks to be Boston Fed's Collins, St. Louis's Musalem, and Kansas City's Schmid. Undecided but seemingly leading against is Chicago's Goolsby. He told me a couple weeks ago that the bar for cutting is much higher as inflation has been trending in the wrong direction. And on the flip side, Waller, Myron, and Bowman are in favor of a rate cut. And then we have the clump who could go in either direction, including Fed Chair Powell. But either way that you slice this, it looks like we're going to see dissents on either side, 3 to 4 if the Fed decides to cut. And then if the Fed decides to hold steady, the potential for 3 dissents there. And if you take a look at traders and what they're pricing in as far as the odds of a December rate cut, looks like those chances are dwindling right now for the month of December. Odds down to about 45%. That's down from about a month ago when the odds were 94%. In fact, I think it was as low as nearly 40% earlier today. And quite frankly, Myles, I mean, Fed Chair Powell stood at the podium about 2 weeks ago and told the markets in no uncertain terms that a rate cut in December is not a foregone conclusion. In fact, far from it. Back to you.
And speaking of, Jen, that where the Fed is breaking down and what it might look like 6 months from now, we got news earlier this week that Atlanta Fed President Raphael Bostic will be retiring early next year. Another opportunity it is looking like for the president to reshape the Fed. And again, this is still without having yet known, we don't yet know, who Trump will nominate to succeed Chair Powell come May.
That's right. There are a lot of factors that could change and shape the Fed as far as the players next year. As you mentioned this week, Atlanta Fed President Raphael Bostic going to be stepping down next February. So that was when his term was set to expire anyway. And he is on record for penciling in just 1 rate cut this year. So depending on how the board of the Atlanta Fed decides, or who the board of the Atlanta Fed decides to replace him with, we could see a potential turn in that chair. Granted, the Atlanta Fed does not have a vote on the FOMC until 2027. Nevertheless, they could still influence the direction of the committee. Also, as you mentioned, we're going to see a new Fed chair put in place when Chair Powell's term ends in May. And it's clear the president is looking for somebody with a dovish position. And so that person is going to have a strong amount of influence over the committee. Another wild card is the Supreme Court ruling in January over whether the president has authority to fire Lisa Cook. If the high court votes in favor of the president, then that could be another potential opening for the president to fill the Fed with those who are more dovish. At the same time, we know that there are 4 regional Fed bank members who rotate every year. So 4 will rotate off the committee from this year and 4 will rotate on next year. And if you look at who's coming on, guess what? They look hawkish as well. So we could still see a divided Fed next year, but still a lot of question marks outstanding right now.
All right, we'll leave it there. Jennifer Schongberg, thanks so much. All right, tech stocks staging a little bit of a recovery on this Friday after yesterday's steep losses, but the Nasdaq back on track to end the week in the green. Joining me now with the latest on the market action is Stephen Dover. He is the chief market strategist at Franklin Templeton and the head of the Franklin Templeton Investment Institute. Stephen, thanks for jumping on. Let's just start with what you make of what I perceive from my chair as sentiment that is out of step with what you see when we're going to look at the headline indexes this week. It's going to look like a flattish week, but things feel much worse out there. Are the conversations that you're having with folks kind of in step with that idea?
Yeah, great question, because I've been traveling the last 2 weeks, literally globally. And the big question over the last couple of weeks is all of this investment that AI is making, are they going to get a return on that investment? And I think the market volatility of this week was really that question. And if there's a stock that really says that, it's Oracle. So to the extent you've got AI companies that are funding capital expenditure through their profitability, that's generally okay. When you start to see kind of circular funding, or in Oracle's case, a need to borrow money, that was really what I think the question was going on in the market this week. And ultimately, as you said, it ended up flat. We do think there are a lot of tailwinds for the market over the course of this next year, and the market's likely to be up broadly. And in fact, I'll use that word because we're recommending to investors that they invest much more broadly than the concentrated investment they probably currently have in the Mag 7, or at least in AI-related stocks.
Yeah, and it's been interesting. If you look over the last couple of years, really starting with 2023, we've seen several of these periods where the indexes look fine, but underneath the surface, someone might be, half their portfolio might be down 10, 20, 30% or more. So I'm curious, in these sorts of moments, when you're talking, with investors, is there a sense of frustration maybe around some of that concentration where, your benchmark is, whatever, the Russell 1000, Russell 2000, S&P, they don't benchmark the S&P usually, but you're struggling with this and you're like, look, I can't own this in this percentage. I'm going to have to be, trailing what I'm kind of going for here.
Yeah, that's a great question. So I think it's known, but most active portfolio managers, because AI is so concentrated in the indexes, can't overweight, and in many cases can't even weight the same as the index. And so that's the reason why some active managers, or many active managers, haven't outperformed the indexes. I think your second comment or frustration is investors who've gone passive to try to have a diversified portfolio are now living in a situation which they're not diversified. And the strategy to be diversified, not only within the equity market, but so many things are correlated now, I think is probably the number one issue that investors are kind of frustrated with or trying to figure out. And they're trying to look at risk. And of course, they're looking at traditional risk, downside risk-adjusted returns, but there's also this concern of missing out. So there's upside risk, particularly if we're right that the market's going to go up.
So let's talk about some of those other parts of the portfolio, specifically as it relates to fixed income, and then also gold and where that fits into this mix of, I think, things that have acted a little bit better, but gold wasn't exactly an in-favor trade, 18 months ago or so.
Yeah, so let's first talk about fixed income. I think that when we look at investors, at least retail investors, there's just a wall of cash that they've built up. That's not only in the US, that's globally. Made some sense. They were afraid of getting back in the market after April, and it kept going up. When do you actually get back in, I think is the question. And cash has had a decent return. So we think short-term rates are going to drop. By the way, we don't think 10-year rates are necessarily going to drop, but it makes a lot of sense to get out of that cash and at least get into some shorter duration, and then look as interest rates perhaps drop into this next year in terms of getting into bonds and into duration. Right now, we think an area that makes a lot of sense for individuals is municipal bonds. They haven't fully participated in the rally of bonds. There's all sorts of technical reasons for that, but if there's an area in fixed income that makes sense, it's municipal bonds. And then for somebody who's trying to be diversified in fixed income, we think global bonds make sense, particularly emerging market area, where a potential falling dollar and just strength in those markets have done very well. Gold, that's always a tough one for somebody like me, because gold's very difficult to value by definition, because there's no discounted cash flow or anything in that. That said, gold, as we move towards a world where there's a little disintegration of the US dollar as the reserve currency, central banks are buying gold. I literally just came back from India and Brazil and an emerging markets trip, and in all those countries, investors seem to be buying gold. So it does make some sense to me that a small amount of gold in a portfolio is a good diversifier.
All right, we'll leave it there. Thanks so much for the time, Steve.
Great.
Over.
Thank you very much.
All right, coming up, we're going to get one analyst's take on Walmart's CEO change next on Market Domination. Well, Walmart is entering a new chapter. Its longtime CEO, Doug McMillon, will be retiring at the end of January after what will be a 12-year run leading the retailer. The announcement coming as Walmart gears up to report its next earnings on Thursday morning before the market open. And for more, we're bringing in Scott Mushkin. He is R5 Capital's founder and CEO. Scott, so let's start with what we know, what you know about McMillon's replacement, kind of, John's chart through Walmart's history, how you think about this replacement in the context of where Walmart goes from here.
I think extraordinarily highly of John Furner. I've known him for years. If you look at the Walmart U.S. business, it's been remarkable to see it. I've been an analyst covering Walmart for 25 years. We consult significantly into the retail world on the consulting side, and the transformation of that business as John has been running it has been something I would just never have seen. It's obviously him and his team. But as you look for a replacement of Doug McMillon, I don't know who else I would have gone to, given the performance of what John ran over the last several years. Great pick. Going to be sad to see Doug go. Doug was transformational. Will probably go down as the second greatest CEO of Walmart. Obviously, the first one does probably need to be said, but Sam Walton. But exciting time for Walmart, exciting time for John Furner. Like I said, I know him well. I'm excited for him, but I think it's a great pick by the company to name him CEO.
So let's go back in time a little bit to when Doug McMillon took the reins. He was named at the end of 2013, took the job Feb 1, 2014. What was that Walmart like, and how does that vision of Walmart, 12 years ago, compare to the company that he's going to be leaving to John Furner early next year?
It is so different. I remember back then when he took over, and back then we actually had to sell on Walmart. We were very negative. I think right out of the gate, I think like any new CEO, he was a young guy. He kind of stubbed his toe a couple times, but then he decided to bring in Greg Ferran into the U.S. business. And that was a real key decision that he made, understanding that the Walmart U.S. business needed someone, at the helm that could, get back to the basics. And then, of course, Greg ended up turning it over to John Furner. So I've seen Doug grow over the 13 plus years. He's not that much older than I am. He's a quintessential CEO. He's kind of an old school CEO, humble, giving credit to the people that work for him. Nice man. I wish him the best. He has turned Walmart into, a formidable company. Not that it wasn't before, but now it's competing on its front foot, and John gets to inherit Walmart in that position.
So when we think about, let's say the first couple years of John Furner's tenure, what to you are the moves that either, the strengths he ought to lean into, or opportunities that maybe are presenting itself to Walmart in this retail moment, both with, habits among consumers changing, but I think some of its chief rivals really stumbling over the last couple of years as well?
Yeah, so being a CEO of a division, you pick your people and everything, but now he's not only doing that, he's leading strategy, but the people he picks, John Furner will pick, are really important. So who's going to take his position running Walmart US? That's probably his number one decision before, and we don't know yet. They said the announcement's coming. My thought process is Chris Nicholas. He's the CEO of Sam's. He was COO of Walmart US under John for a long time. Excellent executive, so my money's on him. And what they need to do is kind of continue what they're doing. Now, from a research perspective, we've just been glowing about some of these changes and their people. 26 is a big year from Walmart. We need to see their unit volumes accelerate. And we think you compare Walmart not to Target, not to like maybe a Home Depot or Lowe's. You're comparing Walmart to Amazon North America. If you look at Amazon's North America business, it's growing units 12% in in-home consumables overall, but also in in-home consumables. Walmart's growing 1 or 2% units, which is way better than the industry, but we need to see that accelerate next year. And we believe part of it will be through price. So whoever takes the reins of Walmart US, has got a big job in front of him or her to see that growth accelerate, because we need to see it to support its multiple. It's an expensive stock, expectations are high. So we need to see it from an investment perspective.
And then maybe stepping back, we'll end on this, stepping away from Walmart specifically, but just is there a challenge, let's say, to a CEO coming into a company, because you mentioned a stock that has performed really well, that has beat its peers, that has been really good for shareholders to come in and continue that story? Because again, running a unit, very important part of it, but going out to investors and explaining why your stock is going up or down, saying why you think it should go up or down, that's a little bit of a different, task ahead of someone in that seat.
Very insightful. Absolutely. First year is going to be critical, setting the bar, articulating his strategy. But it definitely, it's funny, like it's in a great position. A lot of the reason Walmart's in a great position is because of John Furner. But because of that, the bar's set high, the stock multiple's high. So any stumble is going to be looked at quite significantly because of what Doug McMillan's done. So a lot of pressure, absolutely a lot of pressure on John Furner. But if there's a guy that can handle it, it's John. I have a lot of confidence in him and him steering the company and where it is competitively. Now, like I said, next year is really important, but they've set themselves up for success, and I think that's a good place to start. I'd rather have a lower multiple if I were him, but unfortunately, he's done too good of a job.
Yeah, tough coming in at, I don't actually know what it's trading at, but better than,
30 times.
30 times, right? Harder at 30 than it is at, 12 or whatever it was back in the day. All right, Scott, appreciate the time. Have a great weekend.
Yeah, thanks for having me.
All right, well, former Federal Reserve Vice Chair Lael Brainard joined Yahoo Finance Invest on Thursday to discuss the Fed's path forward as the central bank navigates limited economic data.
Going into the December meeting, it's just much less clear where the Fed is going to go than it was back in September. And it's not primarily because of the lack of data, although the lack of data just makes it worse. It is because we have heard from both sides of the Monetary Policy Committee that both the hawks and the doves are digging in, with the hawks saying that inflation is 3%. It has been for 44 months now, and it is projected to remain in that territory because of the tariffs. On the other side, the doves are saying that the labor market appears to have softened given the last public sector data that they have, as well as some private sector data, and both sides are right.
Before the government shutdown, Lael, there was a general consensus that the economy was slowing down, as seen through the prism of U.S. labor market data. Why was that happening?
So I think we have a very clear two-track economy. We have the AI sector, and all of the related sectors are seeing record interest in the stock market, are seeing massive investments, data centers, electricity, chips. The leading sector is doing extremely well, but it's not hiring. And the rest of the economy is suffering. It's suffering because it is less favored in the capital markets. It's suffering because it is still trying to digest those tariffs. And then it's also, a lot of those businesses are not clear how much should they hire given what they're hearing about integrating AI into their businesses. So for all those reasons, neither the booming sector nor the remainder of the economy are really hiring. And meanwhile, you have very divergent economies.
Is the economy in a recession?
I would say you saw the second quarter growth number coming in very strong, 3.8%. Consumers remain resilient. Now, we know that that is the top of the consumer income distribution, but they do remain resilient, driving spending. And all the estimates are that third quarter GDP is going to come in quite similar. So the economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
You bring up a good point, Lael. Why do you think the wealth we're seeing built at the top end, as seen through the prism, of course, of the stock market. Why isn't that trickling down to the average household?
So you saw it in the election. Clearly, people in the lower half, even the lower 3/4 of the income distribution, are really concerned about affordability. They've seen prices of coffee and bananas going up, housing costs not coming down, utilities costs going up. So they're very worried about that, and they're worried that their job opportunities are not as good as they were a year or 2 years ago. You see that in the consumer sentiment surveys. Whereas that top 10% of consumers, their housing values have gone up, and of course their stock portfolios are very positive.
I'm glad you mentioned coffee and bananas, Lael, because the Treasury Secretary, Scott Bessent, is out this week saying the administration plans to put policies in place to bring prices down for coffee and bananas. Maybe this is the new egg debate. Whatever the case is, you're in government. Can the administration actually do this? Can they bring these prices down for these two key ingredients?
So, look, I think it is interesting, first of all, to see the Secretary of the Treasury and the administration wake up to the fact that people are really unhappy about prices and affordability. Don't forget, just a few months ago when they were putting tariffs in place, he was talking about how, well, there'll just be fewer toys under the Christmas tree come Christmas time. Now, I think they're seeing that actually consumers are really troubled by this affordability. And to some degree, they can take tariffs off where they've put them on. And that is what they're talking about. But it will be very difficult for them to fundamentally reverse the affordability crisis in areas like housing and, of course, in healthcare because of some of the expiration of the tax credits. It's actually going to get worse for millions of families.
Do you believe the higher prices we have seen, coffee, bananas, whatever it is, furniture, apparel, are tariffs causing this inflation? And then do you think the administration will come to regret these tariffs?
So, look, I think in areas like baby clothes and strollers and toys, furniture, those are clearly tariff related. You can see the tariff lines. Coffee, bananas are hurt by tariffs, but in some cases there are structural forces that are making these worse. And so, for instance, the demand for electricity is growing at a rate we haven't seen in many years because of the boom in AI, and that is inevitably going to put pressure on consumer electricity prices. And that is something that is more complicated and difficult for the administration to reverse. Of course, it didn't help that they got rid of a lot of the alternative energy incentives. They have brought prices down. We're seeing lower prices at the pump by a little bit. But some of these other forces are going to be difficult for them to reverse without reversing their own policies.
I talked to a noted economist, Lael, Mohamed El-Erian, earlier on at our Invest event. He said this, quote, "I believe that this Fed went to sleep." And Mohamed was referencing that the pressure, like you were mentioning too, on lower income consumers. Is the reality that the Fed, that meeting, December 10th, decision day, they need to come out here and cut rates and make it clear that more rate cuts might be needed to ease the pressure on households?
Well, I think they are in a difficult spot because they have the most powerful inflation fighting tool. And of course, with inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. I think most members of the committee believe that this is a transitory impact. They don't like to use that word, but they do expect the tariff effects to dissipate, so no further increases from tariffs eventually. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, a very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that, given where the hawks are on the committee.
If you were still in the Fed, Lael, would you argue for a rate cut?
I would. I would be concerned about the weakening labor market. And I think I would take the risk that perhaps tariffs push prices higher for a little longer against the risk that we really see a self-reinforcing downturn in the business sector that leads to real pain for American households. So weighing those two risks, I think as many members of the committee, including the chair, has articulated, they are more concerned about the risk to the downside on the labor market. We just heard that again from Governor Cook. And they're willing to take a little bit more risk on the inflation side of the mandate.
We'll be right back. All right, well, Bitcoin continues to struggle as it falls below 100,000. That's amid a sweep of risk aversion across markets. Crypto market remaining under strain with some $19 billion in liquidations in turn erasing over $1 trillion from the total market cap of all cryptocurrencies. That is according to data from CoinGecko. And for more on the themes that we are seeing in crypto markets, let's welcome in Ava Labs President John Wu. So John, let's talk a little bit just about the setup right now that you're seeing across the market broadly. And we had a discussion here yesterday on Yahoo Finance. Someone was like, hey, it's only been like 5 Fridays from today that we saw that massive dislocation on that October 10th date. We still haven't really, it seems, healed ourselves in the broader crypto space since then. Does it feel that way to you guys?
It's still in the process of healing from the asset class perspective, no doubt. I think what people sure there was a flush, so to speak, on October 10th. But reality is, over the last 6 months, maybe even a year or so, there's just been so many new instruments where people can access the crypto asset class, whether it is ETFs, whether it's these digital asset treasury companies, or even IPOs like Circle, Figure, or Gemini. All of these new securities, it's just a lot of supply into the market. Plus, there's a lot more tokens as well, and there's just not enough demand to absorb all that. And the irony here is all happening when real-world use and adoption is happening, from the JP Morgans to the BlackRocks to basically almost any industry you talk about. There's like brands using the blockchain technology to streamline their processes. So it's ironic, just as adoption's happening, the asset class is struggling a bit.
Yeah, let's talk a little bit about what's happening specifically with altcoins. I think on this program, we basically just look at Bitcoin, which we're going to talk about in just a second, maybe a little bit of Ether here and there, but it's mostly Bitcoin as gold, et cetera. In those smaller crypto markets, the layer one protocols, as you and the experts will talk about, and even smaller than that. What has that price action been like, and what's the feedback there between the price action in the token and then how much activity is happening on chain, and just where is that space right now for our audience as you guys see it?
Well, I can speak for Ava Labs, Avalanche. Avalanche is a layer one protocol, and Ava Labs, the team behind Avalanche, has always had the mission of creating real-world use cases. And the activity and partners that we're working with to create those use cases is absolutely going higher, while the coin obviously is not doing great. So there's a big disconnect. I can't tell you why that is, but except for the fact on a meta level, there's just too many options now of new tokens, new DATs, new ETFs, for the whole space, and new public companies as well. But I can tell you from my day-to-day, my conversations with brands, with TradFi, meaning Wall Street, they only increase, and the activity we're doing with them is also increasing.
So speaking of that adoption and where it sits within the financial stack, we talked to Michael Saylor yesterday. He expressed his view on where he thinks Bitcoin is going. Let's take a listen.
We're in the digital gold rush, and 2035 is the 0.99 year. That means that 99% of all the Bitcoin will have been mined in the year 2035. If you want Bitcoin, you need to get it between now and then, because the last 1% of Bitcoin comes out over 100 years. Yeah, there's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
So John, you mentioned that institutions now are viewing Bitcoin in that kind of context as a portfolio diversifier. Again, thinking down the crypto stack, whether it's with Avalanche or kind of your competitors in there, how does that change, if at all, or like what does that say to you in terms of how you guys approach your business, your development, with that kind of push for, again, an institutional asset like Bitcoin at that level coming?
That's right. I mean, I think everything is different underneath the hood. Bitcoin, as Michael Saylor is saying, it's really the digital gold or store of value. Everything else, whether it's a stable coin, which is a medium of exchange using for payments, or technologies that things are being built on. For instance, on Avalanche, we've helped the state of Wyoming build their own basically stable coin. We've helped New Jersey tokenize and track land and houses, registry of titles on the Avalanche blockchain. Those are things that are being done that are pushing the technology and the use cases forward. So each one of these altcoins, as you call it, has to be looked at on its own for its own use case or its own product market fit.
So do you think of Avalanche as an altcoin, I guess? That's the way I think about it. Anything that's not Bitcoin is an altcoin. What do you guys
identified it as, so I'm going with it.
Yeah.
I think it's a great one. But there's, the reality is I think there's just too many altcoins right now. And in the end, it's really going to be a handful, maybe 20, 25 of these that are really useful. Avalanche probably, is going to be one of them. And there's probably too many of these meme coins and things out there that actually don't serve any purpose.
All right, we'll work on the branding to get altcoin more distinctive from the meme coins. I think, I hear you. They kind of get lumped together, but there's a difference between something that's got nothing going on and then a protocol you're actually building on. So we'll pick it up next time. John Wu from Ava Labs, thanks so much for the time.
Thank you.
All right, stay tuned. Much more coming here on Market Domination right after this. The AI trade and the future of technology in focus for Wall Street this week, and at our annual Invest event, Yahoo Finance executive editor Brian Sozzi spoke with Reddit co-founder Alexis Ohanian on Thursday, who weighed in on everything from valuations to risks to the labor market. Here's a part of that conversation.
You're a father of young children. What is this AI revolution? What will it mean to how they learn? But in addition, what does it mean for that generation, their ability to find jobs 15, 20 years from now?
Well, okay. So on the latter point, I don't know. I want to believe I'm a tech optimist, and I do think more new jobs will be created than removed from the system. I think an easy example, we were fortunate to be early investors in a guy, Mr. Beast, 5 years ago. The idea of being a content creator, let alone a billionaire because of it, was unthinkable, 15 years ago, 20 years ago? And now it's probably one of the most common professions that a young kid, at least in America, wants to be when they grow up. So there is precedent, right, for, social media. That revolution was a significant one, not nowhere near as big as AI, but it was one that created entirely new career paths, sectors, industries that didn't exist before. And with every technological revolution, there's always new careers, new things that come up that you or I can't necessarily think of. The builders are going to build and do. And so I'm hopeful there are going to be more new ones created. We actually just in DC with one of our companies, Area 2 Farms, where they're franchising vertical farming. And when they talk about what is needed to manage a vertical farm, especially in a dense urban area, where you don't have a lot of space, and because it's more vertical, you're going to have a whole new trades of people who are working on the robotics that help manage those farms and make sure the lettuce, grows on time and whatnot. And so again, we're already seeing AI, robotics, they're two sides of the same coin, creating new jobs, new opportunity, new innovation, better quality of life, right? Everyone deserves access to high quality, well-grown produce, right? Whether you live in a rural community or whether you live in a city. And so I feel like it'll be a net positive. That doesn't mean it won't be a bumpy road. And, how do I prepare my 8-year-old and a 2-year-old for this? I've already been paying attention. I've been tweeting about things like Alpha School, which I think are taking a really smart first principles approach to education. I do think the future of education for, let's say, K through 12 looks a lot more like having guides instead of teachers, where, and that's verbiage from folks like Alpha School and Prenda, where your personalized AI tutor is doing a lot of the instruction, right? I'm a big Duolingo user. You're familiar with that. That is probably the
great platform
expression of that, right? And there's no reason why a kid, regardless of their background, regardless of their home life, shouldn't be able to get personalized education. So if they need extra help with a certain part of math or a certain part of English, fill in the blank, you're going to have AI solve those problems for them, giving them that infinite access and infinite patience to support and customize learning. And then hopefully those kids get to spend the rest of their school day actually interacting and building up their emotional intelligence and solving problems. And I think the school of the future should really optimize the time with the AI to help learn, but also maximize the time off a screen so that kids are getting the things that are going to continue to be valuable when they grow up.
Alexa, let me channel the sports side of your brain. And earlier on today, I had a really good chat with Ted Leonsis, owns the Wizards, several other teams. His portfolio is valued at, I believe, close to $8 billion. We mentioned the Lakers, valued at close to $10 billion. You have been an early supporter, investor of women's sports. When in the world is this valuation gap closed between women's sports and some of these mind-blowing valuations on the men's side of the equation?
Look, it's coming quick. My tweet about how undervalued women's professional sports was in March of 19 went viral for all the wrong reasons, right? I said this is a massive opportunity. I said I was going to either start or buy. It was an NWSL team, professional women's soccer team, and one day it was going to be worth billions. And most people said I was an idiot and no one watches women's sports and that'll never work. And I said, save those tweets. And he ultimately paid a little over $1 million for the expansion fee to start Angel City FC. And in the wake of that success, right now it's valued at the most for any American women's soccer team. Arthur Blank in Atlanta just paid, I think, $160 million for his expansion fee. So that's quite an appreciation over just 5 years. And so it has been really validating to see, to call the shot, to spark that and see the growth. But I think anyone will tell you it's just the start. There is so much more room to grow. And remember, most of these men's teams' value is based on media deals that have been baked over decades. And, whereas for women's sports, when we're building a team, I just bought the LA franchise of League One volleyball. And it's just like 2 weeks ago, so hot off the press.
Congrats. Wow.
We build out, thank you. When we build out the structure for how to build that team, most of our revenue is not going to come from a media deal. Most of our revenue is going to come from brand deals. And so we've been able to build, Angel City's doing tens of millions of dollars in revenue a year. You're seeing a precedent here for more and more women's pro teams to basically build the muscle of revenue generation in a way that's much more about, business, right? It's about how do you drive revenue through brand partnerships and all these things that it turns out lots of CMOs are excited by. And the media deal is still down the road. So you have to earn that media deal through the viewerships, but the brand dollars obviously help you build the brand and prove the value. And it's this virtuous cycle. And you've seen that in the rapid ascent of WNBA team valuations and revenues. And I think, it won't be for every sport, but you can see the places I've been investing, obviously also starting a Formula One for track and field like Athlos. That's an entire league where I've seen this same opportunity that I saw with women's soccer, where the World Cup showed up every 4 years and then everyone was watching and then they all disappeared. The thesis was simple, why not make sure they don't disappear and keep investing? Similarly, track and field is the #1 Olympic sport. These athletes are superstars and then they disappear. They shouldn't disappear. So we built Athlos and 4.5 million people tuned in for our New York meet just a month ago. And we're rolling out a multi-meet league next year with teams. So I'm excited about all this. I think at the end of the day, we're only 5 years away. I think 6 years from my tweet. And I think there is still so much more room to grow in women's sports. I think we will absolutely see billion-dollar women's sports teams as I had laid out, and I will be sure to rub that in the face of all those haters on Twitter 6 years ago.
Last one, and I wanted to save this one, Alexis, because I think this is also in your wheelhouse, and it's also in the wheelhouse of my dear friends at Yahoo Sports. Why are collectibles having a moment, and what is next in this industry?
It has been an amazing ride. We love our partnership with Mantle and Yahoo. We've got some hobby awards right now, actually. I think this industry is starting to professionalize, right? The hobby was always a very mom and pop type business. And during COVID, everyone was locked down. Everyone was feeling pretty anxious, and nostalgia became really, really desirable. And so that's when I got back into the hobby. I collected cards as a kid, like a lot of kids in the 90s. I thought that collection was going to help me retire one day. It did not.
All right, we're wrapping up today's market domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.